So as of June 30, 2026, the U.S. stock market is, well, it's officially worth 2.36 times the size of the entire U.S. economy.
Yeah, and it is a figure that just completely defies traditional financial gravity. I mean, when you really sit with that ratio, you realize we're standing at a precipice that very, very few generations of investors have ever witnessed.
Right. And that is exactly what we're dissecting today. We've got this massive stack of sources in front of us, a whole collection of macroeconomic data, valuation regressions, and some seriously eye-opening historical comparisons.
It's a lot of data.
It is. But the mission for this deep dive is to decode three very specific, extreme economic gauges that are flashing right now. We're going to look at what 150 years of market history says usually happens next and help you figure out exactly where your portfolio stands in this kind of environment. Okay, let's unpack this. We need to start with that staggering 236% figure.
Your Buffett Indicator, right? Famously championed by Warren Buffett as, perhaps the best single measure of where valuations stand at any given moment. It answers a really fundamental macroeconomic question.
Which is?
How massive is the publicly traded stock market relative to the actual real-world economy that's supposedly feeding it? You're basically taking the total market capitalization of all U.S. public companies and dividing it by the U.S. gross domestic product.
I think a good way to visualize the mechanism here is to imagine a single massive house sitting in the middle of a small town.
Okay, I like that analogy.
And the asking price for this one house has suddenly surged to more than double the annual economic output of the entire town that surrounds it.
Right.
The town provides the water, the electricity, the labor, the maintenance. I mean, the house completely relies on the town's infrastructure to survive, but the price of the house has completely detached from the economic reality of the town itself.
Exactly. The asset has entirely outgrown the foundation that supports it. If we look at the 150-year data set from our sources, a historically normal, healthy relationship, the mean for this indicator, is about 111%.
So it normally operates as roughly a 1-to-1 ratio.
Yeah, precisely. The stock market's value should intuitively hover around the economy's actual output.
But at 236%, we are looking at a massive anomaly.
We're roughly 2.8 standard deviations above that 150-year historical norm. In pure statistical terms, that is a profound outlier. I mean, the needle on this gauge is buried so deeply into the significantly overvalued zone that it's pushing the mechanical limits of the historical models.
Wow. Now, if the Buffett indicator measures the total size of that house, the second metric in our sources looks at what you're actually paying for the rental income, right? The Schiller PE, or KPE ratio, is currently sitting at an astonishing 41.7.
Yeah. Robert Shiller's methodology here is so vital because traditional price-to-earnings ratios can be incredibly noisy. Well, a company, or even the whole index, might have one weirdly profitable year because of a tax cut, or one terrible year due to a supply chain shock.
Right, one-off events.
Exactly. So the KP ratio smooths that out. It takes today's stock market price and compares it against a 10-year average of inflation-adjusted earnings. It strips away all that short-term noise to show you the true underlying engine of business performance over a full business cycle.
And a reading of 41.7 is just monumental. Looking at the historical regressions in the notes, the 150-year average for the Schiller PE is around 17.5.
Yeah, 17.5.
So today's number puts us 3.1 standard deviations above the mean. Just to bring some historical context to this, in 1929, right before the crash that kicked off the Great Depression, the Schiller PE peaked at roughly 33.
Which was huge at the time.
Right. And we are blowing past that. In 2021, before the painful 2022 tech drawdown, it hit about 38. We are well above that, too.
The only time in all of recorded financial history that this multiple was higher. Early 2000.
When it hit, what, 44?
Yeah, brushed right up against 44. So we were within whispering distance of the single most expensive stock market ever recorded. But, what's truly crucial to understand here is why earnings multipliers get this stretched.
It's not just math.
No, it isn't just a mathematical quirk. It's a profound psychological phenomenon. You have to factor in liquidity gluts from central banks, the fear of missing out, and, the herd mentality that just completely takes over when a bull market runs uninterrupted.
People stop looking at value.
Exactly. Investors stop asking, what is this underlying cash flow actually worth? And they exclusively start asking, how much higher will the next guy pay for it?
But see, given that we are brushing up against 1999 or 1929 valuation levels, you would naturally assume Wall Street is terrified right now.
You think so?
You'd think institutional investors would be panic buying portfolio insurance. But when we look at the third metric in our stack, the VIX, we see the exact opposite. Wall Street's famous fear gauge, which measures expected market volatility over the next 30 days, is sitting at just 16.5.
What's fascinating here is the paradox of that complacency. It's what makes this current environment so deeply fascinating and, honestly, potentially dangerous.
Because the historical average for the VIX is 19.
Right. The market is not experiencing high valuations alongside high fear. If institutional money was terrified, it would actually make sense.
It would mean they're paying attention.
Yeah, it would mean the market was self-aware, pricing in a massive risk premium because it knew it was on thin ice. Instead, we're experiencing record-breaking, multi-century valuations with absolute apathy. Literally no one is buying put options to hedge their bets.
It's the equivalent of flying a plane at 40,000 feet, the engines are running red hot, and absolutely no one in the cabin is wearing a seatbelt.
That is exactly it.
And what makes this lack of fear even more glaring are the macroeconomic conditions highlighted in the reports. I mean, we're not in some perfectly tranquil economic Goldilocks zone. Inflation is stubbornly running above 4%. Unemployment remains tight, which continues to put upward pressure on wages and input costs.
And when you synthesize those macro realities with these three gauges, a 236% Buffett indicator, a 41.7 a key E ratio, and a sub-17 VIX, it paints a very definitive portrait.
Scary one.
The market is priced for flawless, uninterrupted economic perfection, yet it's insured for absolutely nothing. The margin for error is essentially zero.
Okay, so let's zoom out and look at the mechanics of what happens next, because it's incredibly easy for someone to hear these numbers and just assume it means the market is going to collapse on Thursday morning.
Right, which isn't the case.
But our sources are very clear about the difference between valuation and timing.
Valuation is a notoriously abysmal tool for market timing. Markets can stay irrational, and they can drift from expensive to outrageously expensive for years.
Yeah.
Using a KPE ratio to predict a recession next quarter is just a fool's errand. However, where valuation shines or becomes an almost ruthlessly accurate forecasting tool is in predicting long-run returns, specifically your compounding returns over the subsequent 10 years.
Right. I was reading through the mean reversion mechanics in the notes, and I think the best way to understand this is to treat extreme valuations like a payday loan.
Oh, that's a great way to frame it.
When you buy the S&P 500 at 2.36 times GDP, you aren't creating new economic value out of thin air. You're essentially borrowing your investment returns from the future.
Yes.
You get the price spike today, but the mathematical reality eventually comes due over the next decade.
The regression evidence across a century and a half of data makes that painfully clear. The relationship is unbroken. The higher the premium you pay for $1 of corporate earnings today, the lower your annualized return will be over the next decade.
It's just gravity.
Historically, when the starting Schiller PE pushes above 35 or 40, the subsequent 10-year real returns, meaning your actual purchasing power after subtracting inflation, they cluster tightly between a negative 2% to a positive 2% annualized.
Which completely shatters the conventional wisdom that you can just dump money in an index fund and automatically expect your 7 to 8% real return.
Completely shatters it.
That 7% assumes you're buying in at a relatively average historical valuation. When you buy at the peak, that entire return profile just evaporates.
We can see the anatomy of that evaporation in the analog decades from our sources. Look at the dot-com peak in 2000.
When the S&P was at 44.
Exactly. If you bought an S&P 500 index fund then, 10 years later, in 2010, your portfolio had actually lost purchasing power.
Yeah.
It was famously dubbed the lost decade for equities. You took all the risk of the stock market, and your reward was 10 years of literally zero progress.
And the 1929 analog is even more severe, isn't it? Buying at a KP of 33 back then meant waiting essentially an entire generation just to break even on an inflation-adjusted basis.
An entire generation.
Yeah.
But conversely, look at the launchpad of the 1980s. If you bought equities in 1982 and the KP ratio had compressed all the way down to 8, you caught the updraft of the greatest secular bull market in history.
Right.
The starting valuation dictated almost the entire narrative of the subsequent decade. The mean reversion arithmetic of the Buffett indicator demands the exact same thing. If the ratio is at 236% today, for it to drift back toward its 111% historical baseline, one of two highly uncomfortable things has to occur.
Either stock prices flatline and go entirely sideways for a decade while the underlying GDP slowly catches up to the valuation, or prices suffer a severe contraction and take years to slowly rebuild.
That is just the mathematical reality of what the word overvalued means in a closed system.
Hold on, though. I have to stop you there and push back on the historical gravity of this, because I'm looking at a chart in our sources showing the Buffett indicator over the last 20 years.
Okay, sure.
If I had looked at this exact same gauge back in 2013, when it crossed 120% and technically entered the overvalued territory, and I say panic sold my entire portfolio,
You would have missed out.
I would have missed out on an absolute historic tear. I would have missed a decade of massive wealth creation. So doesn't that heavily imply that the gauge itself might be fundamentally broken in the modern era?
It is the most critical counterargument in this entire discussion, and we really have to examine it thoroughly. It's very easy to dismiss the phrase, "this time is different," as just the calling card of a bubble. But there are highly credible, structurally sound reasons why these specific metrics might naturally run hotter today than they did in, say, 1970.
The denominator problem is the one that jumps out immediately. The Buffett indicator divides total market cap by U.S. GDP, but U.S. GDP only measures the goods and services produced within the borders of the United States.
Right.
Meanwhile, we have modern behemoths like Apple, Microsoft, and Google generating a massive percentage of their revenue globally. In Europe, in Asia, all over the world. We are taking the global market capitalization of these tech giants and dividing it by a strictly domestic economic yardstick.
Yeah, that structural mismatch practically guarantees that the ratio will skew higher over time as U.S. corporations become increasingly transnational. The fair value baseline might realistically sit much higher than the historical 111%, because the economic foundation supporting these companies is now the global economy, not just the American consumer.
And then add the massive shift in how capital actually flows into the market today. We have a passive investing machine that didn't exist in 1929 or even 1999.
The 401k flows.
Exactly. You have tens of millions of workers with 401ks, and a portion of their paycheck is just blindly, automatically routed into S&P 500 index funds every 2 weeks. This capital doesn't care if the Schiller PE is 15 or 45, it just buys.
It's relentless.
That continuous price-insensitive liquidity hose has completely altered the supply and demand dynamics of public equities.
Furthermore, you have to consider the structural decline in interest rates over the last 40 years. When the risk-free rate of return on a treasury bond is historically low, capital is forced further out on the risk curve to find yield. Mathematically, in a discounted cash flow model, lower interest rates justify paying significantly higher multiples for future corporate earnings.
And we haven't even touched the most dominant narrative of the current cycle, the artificial intelligence boom.
Yes.
The core argument from the bulls is that if AI actually delivers on its sci-fi promises, if it triggers a sudden massive spike in global worker productivity and corporate profit margins, the market doesn't actually need to crash to revert to the mean.
It can just grow into these valuations.
Exactly. The denominator, the earnings, and GDP will simply skyrocket to justify the massive price tag we see today.
Those structural shifts present a really formidable case for why expensive might be the new normal. But we connect this to the bigger picture. We have to resolve this tension between 150 years of brutal mean reversion and these modern catalysts.
How do we do that?
The framework for resolving that isn't to view these gauges as binary sell signals. A 236% reading is not an instruction to liquidate your portfolio and go hoard physical gold.
It functions much more like a dashboard warning light.
Right.
When the seatbelt light flashes on your dashboard, it doesn't guarantee you're going to slam into a wall in the next 3 miles. It tells you that if the brakes lock up or if another driver swerves into your lane, you currently have absolutely zero margin of safety.
That's perfect. It quantifies your vulnerability. It tells you exactly how much premium you're paying for the assumption of future growth and how heavily the odds are skewed against you over the long run.
Which transitions us to the practical application of this data. What does this actually mean for you, the listener? How do sophisticated investors navigate a dashboard that is flashing bright red across the board?
Well, it's highly instructive to look at what the namesake of the indicator is doing.
Warren Buffett. What is he actually doing right now while his gauge sits at 236%?
Berkshire Hathaway is notoriously accumulating the largest cash pile in its entire corporate history. Rather than deploying capital into public equities at 41 times earnings, Buffett is happily sitting on short-term treasuries. He is letting the cash build.
Just waiting.
Watching how the architects of value investing actually deploy their capital at extremes is often far more illuminating than listening to daily financial punditry.
While our deep dive is an exploration of the research and obviously not personalized financial advice, the sources outline a very specific set of behaviors that experienced investors historically adopt in these stretched environments. The first one is a total calibration of expectations.
Recognizing that the next decade is highly unlikely to mirror the massive easy gains of the previous one, they mentally and financially stress test their plans for a low-return environment, ensuring their retirement or withdrawal rates don't rely on a constant 10% annual equity growth.
Second, they demand a margin of safety. When the broader market index offers no cushion for error, the focus shifts entirely to price versus intrinsic value on an individual asset level.
Third is the discipline of rebalancing. They don't abandon equities completely because, as we discussed, markets can remain irrational for years.
Right.
But they aggressively trim the positions that have become completely detached from their underlying cash flows, and they reallocate that capital to less correlated assets.
Which leads to the strategy of keeping dry powder, holding a strategic portion of cash or short-term equivalents. In a 41 CP environment, cash isn't just a drag on your portfolio losing purchasing power to 4% inflation. It's actually an active call option.
Yes.
It is the liquidity required to actually buy the ensuing panic if and when the mean reversion finally happens.
It all fundamentally boils down to situational awareness. And navigating this doesn't require a master's degree in econometrics or manually calculating standard deviations every single morning. The sources highlight several streamlined tools built precisely to track this macro environment.
Yeah, if you're an iOS user, there is an app simply called Buffett Indicator, and the Android equivalent is Bubble Watch. The brilliance of these platforms is how they change investor psychology from reactive to proactive.
He makes it real.
You open the app, and in 10 seconds, you see the live, real-time readings for both the Buffett Indicator and the Schiller PE. It color-codes the data into plain English zones, mapping exactly where today's valuations sit against the 1929, 2000, and 2008 peaks.
It is the macroeconomic equivalent of checking the weather radar before you plan a long trip. And for investors who require deeper granular analytics, who want to move past the broad market weather and calculate the intrinsic value of specific equities to locate that elusive margin of safety, the sources point to the comprehensive web platform, deepvalues.ai.
I really appreciate the analogy used in the source notes to describe this ecosystem. The mobile apps are the thermometer you keep in your medicine cabinet, but Deep Values is the entire diagnostic hospital.
The overarching takeaway from compiling all this historical data is a deeply sobering one. The investors who saw their wealth obliterated in the crashes of 1929, 2000, and the global financial crisis, they weren't inherently foolish.
No.
They simply lacked the situational awareness of where they were in the broader historical cycle. Checking the gauge requires minimal effort, but ignoring the gauge has historically cost investors a decade of their financial lives.
We want to thank you for joining us on this deep dive. To synthesize everything we've covered today, the U.S. stock market is currently trading at multi-century extremes, entirely detached from the underlying economic output, while paradoxically enjoying a period of historic calm and complacency.
The dangerous mix.
It is a potent cocktail that demands extreme awareness. It demands a seatbelt, but it does not demand outright panic.
And as you process all of these metrics, there's one final lingering thought from the research that you should mull over on your own. It builds on that deep tension between the gravity of market history and the alluring promise of modern technology. Every single devastating financial bubble in modern history was built on the foundation of 4 words. This time is different.
The most expensive words in the English language?
So as you watch the genuinely incredible paradigm-shifting advancements of artificial intelligence unfold, and you weigh that against 150 years of brutal, unforgiving financial mathematics, you're forced to answer a profound question. Are we truly crossing the threshold into a brand new era where AI productivity permanently rewrites the laws of economic valuation? Or is the overwhelming belief that this time is different simply the final definitive proof that we are standing inside a historic bubble?
A really heavy question to leave you with, because whether you are looking at a house priced at double the town's income or an equity market priced at 2.36 times the entire American economy, the rubber band can only stretch so far before the tension has to resolve. Keep your eyes on the gauges, stay aware of the weather, and we'll see you on the next deep dive.